Common Stocks and Uncommon Profits by Philip A. Fisher. This is a book summary. What if I told you that the secret to building long-term wealth isn't found in high-frequency trades or following the next hot stock tip? It isn't in reading tea leaves disguised as financial headlines. It's in thinking like a detective, not a gambler. Because while the herd chases noise, the wise investor listens for signals. Welcome to Common Stocks and Uncommon Profits, the timeless classic by Philip Fisher, a man whose quiet wisdom echoed so loudly it shaped Warren Buffett's legendary strategy. Buffett once said that Fisher's thinking was woven into his own, not just stitched, but intertwined. So today we're diving into the principles that separate speculation from strategy, hype from honor, and randomness from results. Let me take you inside the mind of a legend, a man who taught the world that buying a stock is buying a business, and that understanding that business better than anyone else is the true edge. The 1950s, post-war optimism. A booming economy, Wall Street was alive with opportunity and noise. Most investors at the time were focused on short-term trades, gambling on price swings, and flipping stocks like poker chips. The get-rich-quick mentality was king. But amidst that chaos, one man was whispering a different tune. Philip Fisher didn't look at stocks. He looked through them, into the heart of the business, the people running it, and the ideas driving its future. His mission? Not to make money next week, but to identify businesses that would still be thriving 10, 20, even 50 years from now. To Fisher, a stock wasn't just a ticker symbol. It was a living, breathing organism with a culture, a purpose, and a potential trajectory far beyond what financials alone could show. Chapter 1. The 2 ways to make money in the market. Let me tell you a story. Imagine 2 investors standing at the same fork in the road. The first is a market timer. He watches economic data like a hawk, trying to predict the ups and downs. He buys low, sells high, or at least he hopes he does. His success depends on being exactly right more often than he's wrong. He rides the roller coaster of interest rates, inflation reports, and geopolitical drama. It's thrilling until it isn't. The second investor, he doesn't care where the economy will be next quarter. Instead, he spends his time finding extraordinary companies, businesses with visionary leadership, strong product pipelines, and a culture of innovation. When he finds one, he buys it. And then, he holds it through recessions, recoveries, and revolutions. Because he knows something the first investor doesn't. Great businesses survive storms. And the best ones emerge stronger. Fisher believed this second investor, let's call him the business buyer, always wins in the end. Why? Because while the market may be irrational in the short term, over time, it rewards substance over speculation. And as Fisher puts it, the real money is made not in buying and selling, but in owning and understanding. Chapter 2. The Scuttlebutt Method. This is where things get Sherlock Holmes level interesting, because Philip Fisher wasn't just an investor, he was a corporate detective. While others pored over balance sheets and quarterly earnings like fortune tellers reading tea leaves, Fisher put on his trench coat, figuratively of course, and hit the streets. He believed the truth about a company wasn't just hidden in spreadsheets. It was whispered in corridors. It lingered in conversations. It lived in the scuttlebutt. What is scuttlebutt? It's the art of intelligent eavesdropping, of gathering first-hand, ground-level intelligence from the people who see the company not from a distance, but from within. Fisher would talk to employees, past and present, suppliers who shipped the raw materials, competitors fighting for market share, customers using the product, distributors, even the janitor, if he thought that janitor had been around long enough to witness the company's real character. You can learn more about a company at lunch with the right factory worker than in a week with their balance sheet. That's not just clever, it's powerful. Because in those conversations, Fisher was uncovering the intangibles, the culture, the morale, the leadership. He was feeling the heartbeat of the company. He'd ask, is management trusted by their team? Are competitors nervous about their next move? Do suppliers see them as reliable or erratic, one of his favorite techniques, interview 5 companies in the same industry and ask each one what they honestly think about the other 4. Who's leading? Who's lagging? By the time he was done, a pattern always emerged. This was Fisher's edge. It was time-consuming. It wasn't glamorous, but it worked because numbers can lie. But people's stories, when cross-checked and verified, they reveal the truth. Scuttlebutt wasn't about gossip. It was about getting real. Chapter 3, the 15-point checklist. Once Fisher gathered his intel, he ran every potential investment through a brutal, no excuses filter. 15 points, each one a test of long-term greatness. Not short-term earnings, not stock price momentum, but the deep structural DNA of a truly exceptional company. Let's look at just a few. Does the company have products or services with real long-term growth potential? Not just hot right now, but capable of transforming or dominating an industry over the next decade? Does management have the courage to innovate, even when it means disrupting themselves? Are they just keeping the lights on, or are they building the future? Is the company focused on healthy profit margins, not just bloated top-line sales? Fisher knew that flashy revenue means nothing if profits are leaking out the back door, and those are just 3 of the 15. Others explore management integrity, R&D efficiency, cost controls, depth of leadership, labor relations, even whether executives go silent when things get tough, a red flag in Fisher's book. These aren't just points on a checklist. They're X-rays. They let you see beneath the skin of a company, into its bones. And guess what? Warren Buffett took notes, literally. Fisher's 15 points became part of the very foundation of Buffett's partnership with Charlie Munger, especially their shared belief in quality businesses with durable competitive advantages. Fisher showed the world that investing isn't about predicting the future. It's about understanding the present deeply enough to bet on it for years to come. And when you get it right, when you find a company that passes all 15 tests, you don't just invest, you own. Chapter 4, Matching Investments with Your Personality. Philip Fisher didn't believe that great investors were born with superhuman IQs or that they emerged from the halls of Wall Street armed with complex models and algorithmic trading bots. No, he believed they were born in something much simpler: curiosity. Do you get excited when you discover a new business model? Do you find yourself asking, how does this company actually make money? Do you love peeling back the layers of a product, a team, a mission? Then congratulations, you're already halfway to becoming a world-class investor. Fisher understood that the best investments are made by people who care, not just about numbers, but about stories, about why a company exists and how it solves problems. He even said the average investor might imagine that success comes from crunching financial statements in solitude. But in reality, the most successful investors are those with a genuine interest in business itself, the kind who enjoy digging deep into what makes a company tick. And what if you don't have the time to do all the digging yourself? That's okay. But if you're handing the shovel to someone else, a financial advisor, you'd better choose wisely. Fisher advises, don't just take their word for it. Ask for their record, their philosophy, their scars and wins. Make sure they invest the way you believe in investing. Because if they're playing poker while you're playing chess, you're going to lose either way. Just like investing in a company, investing with a person means knowing their track record, their values, and their game plan. This chapter isn't just about stocks. It's about alignment between your money and your mind. Chapter 5. When to buy. Let's walk through a classic Fisher scenario. A company announces it's building a new plant. A huge move. Costly, ambitious, future-focused. But then, the expenses pile up. The supply chain hits snags. Production lags. Bugs need working out. Earnings dip. Wall Street, it panics. The stock price tumbles. Analysts downgrade it. Shareholders flee like it's on fire. But you're not watching the flame. You're watching the foundation. You know the factory is a long-term asset, not a short-term liability. You've done the homework, maybe even some scuttlebutt. You know the leadership team is solid. You've seen this story before. This is when Philip Fisher would lean in. He knew that in every temporary earnings dip, in every misunderstood capital investment, there could be massive upside for those who could see the forest through the falling trees. This is one of the most powerful principles in Fisher's philosophy. Don't just invest in performance, invest in potential. He put it simply, the investor should be thoroughly sure in his own mind that these troubles are temporary rather than permanent. Then if these troubles have produced a significant decline in price, he would probably be on pretty safe ground. Let everyone else run for the exits. You walk in, quietly, confidently, and early. Because Fisher knew something that still rings true today. The best time to buy a great business is when it looks like a bad one. Chapter 6. When to sell. Selling a stock is often where emotions run wild. Fear, regret, doubt. You think, should I cut losses? What if it bounces back tomorrow? What if I miss out? But Philip Fisher? He didn't panic sell. He didn't sell because of headlines or mood swings. His rules for selling were crystal clear and refreshingly simple. Reason number 1, you were wrong. Maybe you thought management was visionary, but they turned out to be more smoke than fire. Maybe the product looked revolutionary, but the market just didn't care. It happens. And when it does, admit it. Move on. Reason 2, the company lost its edge. Maybe they stopped innovating, or the culture decayed, or they clammed up when the going got tough. One of Fisher's biggest red flags. If the core of the business no longer matches the greatness you invested in, it's time to say goodbye. Reason 3, you found something better. This is the rarest and most strategic reason. You're not leaving a bad investment, you're chasing a better one. An opportunity with more potential, stronger fundamentals, or more favorable timing. That's it. No selling because the market looks shaky. No selling because the stock hit an arbitrary price target. No selling because everyone else is. Because Fisher knew something critical. The big money is not in the buying and the selling, but in the waiting. And waiting only makes sense if you're holding on to greatness. So when you're wondering whether to hit that sell button, don't ask, what is the price doing? Ask, has anything truly changed? If the story of the business is still strong, hold. If the plot has unraveled, exit the theater. Chapter 7. The dividend illusion. Dividends. Ah yes, the investor's comfort food. Regular, tangible, satisfying. And sure, Fisher didn't say they were bad. He said they were overrated. Why? Because too many investors fixate on dividend yield as the holy grail, thinking the bigger the check, the better the company. But here's what Fisher knew. A truly great company doesn't hand you cash. It uses that cash to build something even greater. More products, more markets, more future. He explained it like this. Every dollar paid out as a dividend is a dollar that can't be reinvested into the business. And if that business has high growth potential, that reinvestment will almost always outpace the return of simply handing shareholders a quarterly check. Not to mention taxes. Dividends are taxed twice, once at the corporate level and again when you receive them. So in many cases, especially for growth-oriented investors, Fisher believed reinvested earnings created more wealth than high dividend payouts ever could. Now, he wasn't anti-dividend. In fact, he said that some dividend was healthy, it showed financial stability and shareholder respect. But the investor who picks stocks because of fat dividends, that's someone missing the bigger picture. Fisher challenged us to ask, would you rather have a check today or own a company that could grow tenfold over the next decade? In the end, Philip Fisher taught us that investing isn't about chasing income. It's about finding greatness and letting it grow. Chapter 8 and 9, the 10 don'ts. Now that Fisher has shown us what to do, it's time for the hard truths. Let's talk about what not to do. Because even the smartest investors can lose everything, not from bad luck, but from bad habits. These are Fisher's 10 don'ts, a list of investing sins etched into the gospel of smart capital. Don't follow the crowd. The market is noisy. And when the herd runs one way, your instinct says, run with them. But Fisher reminds us, the crowd is often chasing yesterday's news. Real gains, they belong to the contrarians. The ones who see value where others see chaos. The ones who don't care what's hot, they care what's undervalued. Don't quibble over pennies when buying a great stock. Imagine this. You found an extraordinary company. It ticks every box. You're ready to invest. But then you hesitate. Because the stock is 50 cents higher than your ideal buy price. Fisher calls this out for what it is. Penny wise, dollar foolish. Missing a tenfold gain because you waited for a 1% drop is one of the costliest mistakes you can make. Don't ignore companies just because they're not flashy. The loudest brands aren't always the best investments. Fisher urges us to look beyond the packaging. Sometimes the company quietly dominating an obscure niche is more valuable than the headline maker of the moment. In fact, many of the best investments are found off the radar. And the big one, don't overstress diversification. This one's controversial. Wall Street preaches it like religion. Diversify, protect yourself. But Fisher saw a different truth. He believed real safety came from deep understanding, not from owning a little bit of everything. Putting big money into a few, thoroughly understood companies will almost always outperform a diluted portfolio of 20 or 30 maybes. He wasn't against diversification, but he was against over-diversification, what he called diversification. Owning so many stocks that your winners are diluted and your losers quietly bleed you dry. Fisher suggested a focused approach. 10 to 12 carefully selected, high-quality stocks across a few diverse industries. That's clarity, not chaos. Because in investing, as in life, it's not how many things you do, it's how well you do the few things that matter. Chapter 10. How he finds growth stocks. Now you're probably wondering, how did Fisher actually find these rare gems, the companies that could grow tenfold over the years? Let me show you. Fisher didn't cast a wide net, he cast a precise one. He'd research 150 to 250 companies, only to invest in one. Why? Because he wasn't looking for good, he was looking for exceptional. A company with products that would reshape industries, leadership with vision and integrity, processes that could scale, and scale profitably. But here's the kicker. Fisher never talked to management until he already knew 50% of what he needed to know. Why? Because amateur investors ask basic questions. Pros? They ask the questions management doesn't expect, because they've already done the homework. Fisher's process was like a slow burn. He'd gather insights through Scuttlebutt, analyze performance against his 15-point checklist, study competitors, talk to suppliers, dissect marketing strategies, then, and only then, would he sit with management. He wanted to see if their words matched the world he had already observed. When you already know the answers, Fisher said, you can tell who's bluffing and who's building something great. And here's something that will blow your mind. Out of all the companies he met with after that long process, he only invested in about half. He wasn't in a rush. He was in pursuit of greatness, longevity, vision, truth. Because in Fisher's world, every dollar you invest is like casting a vote for the kind of business you believe in. And he wasn't voting for mediocrity. Fisher taught us that the best companies don't beg for attention. They earn it through results, innovation, and leadership. Finding them takes time, effort, and courage. But once you do, you don't just make money, you build wealth. Not every investor is chasing adrenaline. Some are chasing something more valuable. Peace of mind. In part 2, Fisher pivots from explosive growth to durable stability. The kind of investing that lets you sleep well at night, no matter what the headlines say. To do that, he introduces 4 pillars every conservative investment should rest on. 1. Low-cost production. If a company can build its products cheaper than anyone else without cutting corners, it has a built-in advantage. Even in a downturn, it survives. When others fold, it thrives. 2. Mastery of marketing. The best products in the world don't matter if no one knows about them. Great companies know how to connect with their customers and evolve with them. 3. Relentless research and development. A company that stops innovating starts dying. Fisher loved businesses that were obsessed with staying relevant, always investing in the future, not just preserving the present. 4. Financial foresight. Numbers don't lie. unless no one's paying attention. Fisher looked for firms that knew their costs, controlled their debt, and could sniff out problems before they became disasters. But even more than systems, products, or strategies, Fisher believed in people. Great companies aren't built by machines. They're built by cultures. Cultures that promote from within, reward initiative, pass knowledge down, not just profits up. And at the top, leaders who aren't afraid of change, but lead it. Fisher reminds us, the most successful companies are those that create environments where every employee feels they are part of something worth building. That's what makes a conservative investment, not the lack of volatility, but the presence of purpose. Price is not equal value. Here's something Wall Street doesn't want to admit. A stock price is not a mirror of truth. It's a reflection of opinion, fleeting, emotional, often irrational. A company can double its stock price and still be undervalued. Or it can crash 40% and still not be worth a dime. Fisher teaches us to separate perception from reality, to train your eye not just on numbers, but on context. Why is the price down? Are the fundamentals broken or just misunderstood? Is the decline temporary or terminal? He uses a chilling example. A company trades at $35, then drops to $22. Most assume it's now cheap. But if the true value is $15 BOV, it's still overpriced. Here it is: buy into companies with a vision, led by people with integrity, and a strategy for long-term growth. Ignore the noise. Never sell because of panic. Only sell when the business itself has changed or when you find a better one. Don't let dividends distract you. True wealth is built through reinvested earnings, not quarterly checks. Mistakes will happen. Learn fast. Course correct faster. Don't punish yourself. Just don't repeat them. And above all, dare to think independently. The stock market, Fisher said, is filled with individuals who know the price of everything, but the value of nothing. Be the exception. Common Stocks and Uncommon Profits isn't just a book. It's a masterclass in business thinking, emotional discipline, and patient conviction. It's not about playing the market. It's about partnering with businesses that can change the world and riding with them for the long haul. If you want to invest like the legends, this is your blueprint. Smash that like button, hit subscribe, and drop a comment below. What's your favorite Fisher principle, and how has it changed the way you think about investing?